Welcome to the Deep Dive, where we take your stack of sources, articles, research, all of it, and just give you that ultimate shortcut to being well-informed. Today, we're cutting through a lot of noise, really, to focus on three massive shifts that are reshaping global business right now.
And it is a lot of noise.
It is. Our sources, they cover everything from, political moves inside Silicon Valley to this huge financial pullback happening in the auto industry.
Right.
All set against a backdrop of pretty complex global trade and regulation. So our mission is simple. Quickly get to the heart of the big shifts in strategy, investment, and regulatory focus that are all happening in early 2026.
And it really is a moment of, I guess, maximal tension. I mean, the documents we have show a clear clash.
How so?
You've got this immense technological ambition, especially in AI, running headlong into really intensifying regulatory oversight
Okay.
at both the state and the federal level. And then kind of underneath all of that, you've got this critical rotation of investors who are pulling capital out of big tech and, well, looking for safety somewhere else.
That's the perfect way to frame it. Okay, let's unpack this. And where better to start than with the billionaires themselves? We're diving right into the volatile world of big tech, where even the richest leaders are taking very different sides on wealth itself.
Yeah, the proposed California wealth tax, this one-time 5% levy on billionaires, it didn't just spark a debate. It really forced some C-suite decisions about risk management that, frankly, split the leadership of big tech.
It's just an extraordinary reveal, isn't it? This huge split in their tolerance for risk.
It is.
On one side, you have the co-founders of Alphabet who took this really strategic route. They preemptively moved a lot of personal assets out of California.
A huge move.
The decision basically says, state-level regulatory risk is now high enough to justify actually leaving. Physical flight.
And this is the insight, right? That flight strategy is just so sharply contrasted by what NVIDIA's Jensen Huang did. He came out and publicly said he is perfectly fine with paying it. It shows that these state-level financial demands are now splitting how leaders respond. Some choose to exit, others choose to, acquiesce. There's no single playbook anymore for the wealthiest people in the valley.
And it's not just about their personal money. It's about their products, their liability. That regulatory hammer is now falling, it seems, hardest on AI safety.
Oh, absolutely. And those concerns are officially entering the courtroom. We're seeing massive precedents being set.
And it's happening so fast.
The speed is what's fascinating here. I mean, look at the settlement between Alphabet, Google, and Character.ai. They agreed in principle to settle cases where their chatbots allegedly harmed minors. This is a huge early signal.
So regulators aren't waiting around.
No. They're asserting their power over future potential harms, not waiting for a decade of bad things to happen. They're holding these companies accountable for safety, like right out of the gate.
And the most immediate kind of toxic issue here is deepfake abuse.
Yeah.
Researchers found this widespread non-consensual sexual imagery being created specifically through xAI's Grok on X.
And xAI is scrambling to tighten its safeguards now that regulators are looking into it. But the key thing for you to see here is the comparison.
Right, with its rivals.
Exactly. Rivals like Google's Gemini are seeing significantly fewer reports like this. And that difference, that abuse rate, it puts a bright spotlight directly on platform design.
And it begs the question, why is one platform's guardrail failing so much more often than the others?
Well, it suggests the foundational architecture or maybe the training data filters that xAI used were just less robust or maybe less of a priority than those used by its competitors. When we talk about AI, we're really talking about an arms race for capability and for safety. And this data shows a clear lag in one of those areas.
Okay, so let's pivot to the constructive side of this, because AI is at the same time moving into these really high-stakes, highly regulated sectors.
Right, where precision matters.
Exactly. I'm talking about health and manufacturing.
That's the pivot we need. The launch of OpenAI's ChatGPT Health in the US is a major, major step, but it's the features they designed that make it trustworthy.
What do you mean?
Well, it analyzes medical data you provide, but, and this is the key, it uses separate, secure storage for that info, and it commits to no training use of that specific medical data.
And that no training use pledge, that's the critical firewall for privacy, isn't it?
It's everything. They know that to get trust in healthcare, which is so bound by HIPAA and privacy laws, they have to show zero tolerance for using sensitive patient data to train their models.
And their rivals, like Google, they're obviously targeting healthcare AI too, but OpenAI really set a high bar here.
They did. And to kind of reinforce that focus on measurable innovation in health, you just have to look at the funding for Pomelo Care.
Okay.
They had a successful $92 million Series C funding round. This is a virtual care provider for women and children that now has a massive $1.7 billion valuation.
So this isn't just venture capital hype.
No, this is a massive validation. Investors are betting on tangible outcomes, like reported reductions in preterm births, lower ER use across their partners. I mean, they cover over 25 million lives. That's the new metric for success in digital health.
That metric, a tangible reduction in medical events, that's what gives it real weight.
Yeah.
But while we're focusing on AI agents and health apps, we can't forget that, physical tech is still advancing.
Oh, absolutely. I mean, the recent CES 2026 highlights, you had all those quirky, futuristic devices, Samsung home theater gear, Lenovo's rollable laptops.
Right, the stuff that looks cool.
Yeah, and these engineering marvels, they remind us that the physical world is still being built, but the supply chains and the IP behind them, they're now completely dictated by geopolitical friction.
And that friction brings us right back to Beijing's focus on AI assets. China is now reviewing Meta's, $2 billion acquisition of the AI agent startup Manus. They're scrutinizing it specifically for export control compliance.
This just signals Beijing's determination to use its regulatory muscle to control strategic AI assets. What leaves their sphere of influence and what comes in? They see this AI agent tech as fundamental national security infrastructure.
So they're flexing their muscle globally no matter where the companies are headquartered.
That's it.
And on a very practical level, all this advanced AI, it's hitting the factory floor in a big way.
It is.
Hyundai Motor plans to deploy Boston Dynamics Atlas robots in its factories starting by 2028.
And they're using Google's Gemini Alphabet's AI to boost the autonomy and the safety capabilities of those robots. We're talking about combining advanced robotics with next-gen AI for real physical labor, moving way beyond simple automation.
Into true autonomous decision-making.
That's the leap. And that transition point from these high-flying tech ambitions to the hard reality of industrial implementation, that neatly brings us to our second big theme from the sources.
Industrial pivots and the dramatic market rotations we're seeing right now. We saw a really telling few days on the market recently. A clear, palpable rotation of capital. The Dow was up, the NASDAQ was down.
Right, because investors were moving aggressively out of those megacap tech names that seemed invincible for so long.
Causing dips for giants like Apple and Nvidia.
And where did that money go?
It had to go somewhere.
It flooded into defense names. Northrop Grumman, Lockheed Martin, RTX, Kratos, they all rallied hard.
And the context for that is talk of a just massive $1.5 trillion FY27 U.S. defense budget.
That kind of potential spending, it provides this immense stabilizing signal to the whole sector.
But how do investors square that rally with the political risk? I mean, right before that huge budget number was floated, defense contractors were facing pressure because President Trump threatened to cap executive pay and halt dividends and buybacks.
It is the ultimate tension, and it shows the market is operating on two different timelines.
Yeah.
In the short term, that policy volatility, the threat of intervention, it causes shares of LMT, NOC, and the others to swing wildly. But in the long term, the sheer size of that $1.5 trillion number just trumps the temporary political noise.
So it's a long-term bet.
It's a calculated long-term bet that the political desire for massive defense spending will, at the end of the day, overcome any desire to micromanage executive pay.
Let's pause here because the auto industry is facing a reality check that is, well, it's hard to overstate. We have to talk about the EV reckoning and specifically the financial shock out of General Motors.
Yes.
GM booked $7.1 billion in massive Q4 special charges.
That's 7 with 9 zeros. It is a clear, painful signal of retrenchment. And for you listening, when we say special charges, these are typically one-time write-downs. They signal that the company's previous strategy has been declared, well, fiscally unviable.
If you break down that number, it tells the whole story. About $6 billion of it is tied directly to scaling back their EV production plans.
Right, which means they are writing off the value of physical assets. Production lines, machinery, inventory that they only recently scaled up because they believed the EV transition would happen much faster.
So much faster.
Exactly. And the other $1.1 billion is for restructuring in China. They explicitly cited softer U.S. EV demand after policy shifts, which suggests the domestic market is just resisting the high prices and the early models.
So the promised rapid EV transition is proving to be way more expensive and slower than anyone anticipated.
Exponentially more.
And yet, While GM is pulling back, a rival like Ford is doubling down on a different piece of the puzzle: autonomy.
A completely different strategy.
Ford has this ambitious plan for level 3 eyes-off, hands-free driving using LiDAR, and they want it on their new EV platform by 2028.
And this is a really crucial technical distinction for you. You're probably familiar with level 2 driving, think Tesla Autopilot or GM Super Cruise.
Right, hands off the wheel, but you have to keep your eyes on the road.
Exactly. Level 3 is the leap. The vehicle handles everything, letting the driver take their eyes off the road for a while, but you still have to be ready to take over if needed.
So Ford is trying to leapfrog Tesla, who relies so much on vision systems, by using LiDAR as the core sensor for this. They want it as a paid feature by 2028.
It's a completely divergent technological bet on how you get to high-level autonomy, vision versus sensor redundancy. And we're seeing these huge bets and these huge pullbacks play out all over the corporate landscape, especially in M&A.
Oh, in the media world, the struggle is now just openly hostile. Paramount Skydance reiterated its $30 per share all-cash hostile offer for Warner Bros. Discovery.
Calling it superior to WBD's current Netflix deal, the whole media landscape is just fracturing.
And to make it more complicated, the Justice Department expanded its review of both potential deals. The scrutiny is intense.
Because these deals determine who controls just massive amounts of content. The government is trying to draw new lines around market dominance.
Meanwhile, a huge deal in the resource sector is quietly coming back to life. Glencore and Rio Tinto have resumed talks on a potential tie-up.
Nearly a year after their first talks collapsed.
And if that were to happen, I mean, the sheer scale of that combined company, the control over key global minerals, it would have enormous geopolitical implications.
Far beyond just the stock market. And before we move on, there's a small but pretty significant logistics note here.
Okay.
Avelo Airlines will halt deportation flights and sharply reduce service at Wilmington, North Carolina, closing its base there entirely.
It's a micro example, really, of carriers just constantly fine-tuning their operations, pulling back to focus only on their most profitable core rev.
Amidst rising costs, yeah.
Shifting gears now, let's look at the essential policy, power, and macro indicators that are going to shape the environment for all these companies and, really, for you.
We saw a key regional energy policy breakthrough in Illinois. Governor Pritzker signed the Clean and Reliable Grid Affordability Act. This is a really crucial piece of legislation. It's almost a model for how states can manage the energy transition without sacrificing reliability.
So this fundamentally changes the operating environment for utilities like Exelon.
It does. The act has a three-pronged approach. First, it enables new nuclear projects by lifting a long-standing moratorium.
Okay.
Second, it provides for 3 gigawatts of utility-scale battery storage. And third, it expands compensation for distributed solar. It's a huge, complex commitment to reliable, non-fossil fuel energy.
And that kind of big infrastructure reform, it takes years to materialize, but it sets the stage for investment right away.
Immediately. And on the federal level, we also got some important clarity on a pretty politically sensitive housing plan. Treasury Secretary Scott Bessent clarified President Trump's plan to bar large firms from buying single-family homes.
And this clarification is the key takeaway for you, the listener, especially if you own rental property or you're just watching the housing market.
Yeah.
The bar would be forward-looking. It would not force sales by current institutional landlords.
Correct. The impact would be on future acquisitions, preventing further consolidation of corporate real estate. It doesn't threaten existing portfolios. And this specificity, it helped calm market fears. We even saw Mark Cuban voice support for the principle of it.
Okay, let's finish up with a quick economic health check. The labor market, it seems to remain resilient, even if it's cooling just a little bit.
Yeah, initial unemployment claims edged up slightly to 208,000, and continuing claims rose a bit to 1.91 million. Overall, solid numbers. Continued strength in employment.
But the trade picture, that provided a massive surprise that really needs some interpretation.
It really did. The October U.S. trade deficit fell a staggering 39% to a 2009 low of $29.4 billion.
So what's the insight there? I mean, a huge drop in the deficit, that usually signals strong economic health.
It does, but we have to be cautious here. The fact that imports fell specifically because of pharmaceuticals, it tells us this isn't necessarily a sign of roaring domestic consumer spending. It could reflect inventory shifts, supply chain adjustments, or even specific trade disputes.
Okay.
That's why the note that year-to-date shortfalls are still above 2024 levels is so crucial. The long-term trend isn't fixed yet, despite this one impressive monthly number.
So what stands out across all these sources, connecting all these threads, is that core tension we mentioned at the start. We're seeing this simultaneous, ambitious push for new, critical tech AI in health, Ford's Level 3 bet right, alongside massive financial retrenchment.
Evidenced by GM's painful $7.1 billion charge for just reversing its strategy and that investor rotation out of tech and into defensive sectors.
Mission accomplished, I think.
Yeah.
We've distilled the essential information on where regulation is tightening AI safety, wealth taxes, and where our core national infrastructure is shifting.
Whether it's nuclear expansion in Illinois or the new guardrails being drawn on institutional housing investment.
We covered a huge amount of ground today, but the story is really about friction and adaptation.
Which raises an important question.
Given all this extreme political pressure and financial volatility around both defense spending and these major corporate mergers, the media battle for WBD, Glencore, and Rio Tinto, what will be the lasting legacy of 2026? Will it be the unprecedented market rotations, or will it be the new lines being definitively drawn between regulatory oversight and corporate freedom?
Something for you to mull on until our next deep dive.